Accounting Basics Part 2, Lecture 7. Lecture Outline. Hello, welcome to Lecture 7 of Equity Master Secrets. This lecture is going to continue our discussion on the lecture we had the previous time. We're going to continue with our discussion about accounting. So this lecture is Accounting Basics Part 2. It's the last lecture on accounting, and after this we'll go on to something else. So what are the topics we're going to cover this time? Well, we'll talk first about the cash versus accrual accounting method. And we talked about it a little bit last time, and this time we want to do it in a bit more detail so that we really understand it well. Then we'll look at the notes to financial statements, which is the remaining part of the accounts that we need to see and understand. And we'll talk about Maruti Suzuki as our example, and this will be applied just to the notes to financial statements part, where we actually go into the accounts and look at the notes to financial statements. So we'll kind of do that in the same way that we did in the previous lecture. And after that we will conclude, and that will conclude our lectures on accounting. Okay, let's get started. Cash versus accrual accounting method. So the first thing we're going to talk about is the difference between cash accounting and accrual accounting. So as we said, we have alluded to this earlier, right? Cash accounting refers to when we record revenues or expenditures at the time the cash transaction occurs. So when you actually pay for something with your cash, then we record the transaction. Accrual accounting records transactions not when the cash exchange takes place, but when the transaction actually takes place. So in many scenarios, you don't pay for things right away, you maybe get them on credit, and in those situations, the timing of cash flows would not necessarily be the same as when the actual expense or actual transaction takes place. So that's the difference between cash accounting and accrual accounting. And now we will explain this in a systematic way as to how we actually record it all. Okay, so let's do this exercise where we'll do a little example, alright? And you just have to play along. So imagine being asked to run your dad's setup for 1 year, okay? And you are a complete novice in accounting. What would your financial statements look like? Now, let's just be clear, novice in accounting doesn't mean that you don't know anything at all, but it just means that you don't necessarily know accrual accounting. So you're going to account based on cash. So here's what you would do. You would, for example, take your cash flows and organize them in this way. So let's look at, let's go through these one by one. So you had the following business related cash flows. You had the cash received from customers, 6 million. We had the cash paid to suppliers, 3 million. Now, one of the accounting conventions, as you've seen, is that we put in brackets numbers that are, in this case, expenditures or outflows. So the 3 million is enclosed in brackets. That's because it's an outflow. So we have the cash received from customers, 6 million inflow. Cash paid to suppliers, 3 million outflow. We have a tax outflow of 500,000, and this is this year plus some of last year's. So let's assume that this money includes taxes we owe for the current year, but also some of the taxes we owed the previous year. We have interest on working capital, which is an outflow of 200,000, and we have other expenses, which is an outflow of 1 million. The total cash inflow or cash outflow is 1.3 million. Okay, and how do we come up with this number? Well, we simply start with take our inflows and subtract all the outflows. So in this example, the inflows are 6 million, okay, which is the first line, and the outflows are all of the other 4 items are actually outflows, right? Cash paid to suppliers, taxes, interest, and expenses. So we would simply do 6 million minus 3 million minus 500,000 minus 200,000 minus 1 million, and that gives you a total cash inflow of 1.3 million. So this is what your accounts would look like if you did not know how to do accrual accounting. Or another way to say this is that if you were accounting simply based on cash, then this is what your financial statements would look like. And this is fine. This does definitely tell us useful information about the company, but we can certainly do better than this, okay? And that's where accrual accounting comes in. The purpose is to paint a better picture of the business performance, right? Something that's more informative than simply cash accounting. Cash versus accrual accounting method. Alright, so let's keep in mind now what we saw on the last slide. We saw a summary of cash inflows and outflows for a particular business. And what we call this cash-based financial reporting, right? So this is recording financial transactions whenever the cash exchange takes place. So whenever there's a cash inflow or cash outflow. And as we mentioned, this is useful, right? It does tell us something useful, right? I do learn something about the company by looking at that. But it does suffer from a serious drawback. Now, what happens with cash accounting? Well, with cash accounting, we record transactions based on when the cash was received or paid out. So why exactly is this a drawback? The drawback is that we do not record it when the actual transaction happens. Okay? And this is really where accrual accounting really comes in. Accrual accounting records when the actual transaction happens, not when the cash was received or paid out. Now, this may seem, in a lot of, for example, fairly small businesses where credit doesn't really come into play, when most of your transactions are cash anyway, then, this is not going to be a big deal. This won't be a significant issue. But when we're looking at large companies, and especially when we're, investing in the stock market, most of the companies tend to be fairly large. And in those situations, there are often serious differences between, when cash is paid out or comes in as to when the actual transaction takes place. Okay, and that's why we have a system of accrual-based accounting. So let's think of when this would be an issue. So for example, imagine in the previous slide when we saw the cash received from customers. Okay, now some of the cash could be sales from the previous year. So imagine you sold items last year, okay? So you made the sale the previous year, but you actually received the cash this year. Alright, maybe your customers have credit. Now the fact is those revenues should actually be reported last year, not this year, because you actually sold the goods the previous year. Alright, so that's what the difference between the two becomes. Now another such situation where this might arise, the company could have bought raw materials on credit. This is not reflected in the cash-based accounting because the cash has not gone out yet. So imagine as part of the company's operations you had to buy raw materials, and you've bought the raw materials on credit but you haven't paid for them yet. Okay, so you're due to pay for them next year. So they haven't appeared as an expense in your accounts this year. But actually we should be counting them as an expense, right? If I've actually sold products that use those raw materials, I can't just report the revenue from the product and not record the expense, right? Just because I haven't paid for it yet doesn't mean the expense hasn't already taken place. So this is where problems occur when we look at simply cash-based accounting. Now, in the last lecture when we talked about the profit and loss statement versus the cash flow statement, these are some of the differences that are going to occur, right? There are certain the timing of cash flows means that there could be differences in the cash flow statement and the profit and loss statement. And usually it's fairly simple to reconcile the two. Normally a company's accounts will always tell us what the differences are, and usually this is done in the cash flow statement as well. Okay, so now let's talk a little bit more about accrual accounting and how exactly we do that. Cash versus accrual accounting method. So how exactly do we do accrual accounting? What is the next step? So what do we do in this scenario, right? What do we do in the scenario that we just discussed, whereby sales were made the previous year but cash was received this year? Or when we bought raw materials on credit and we haven't paid for them yet. What do we do in these scenarios? The answer, of course, is accrual-based accounting, in case you didn't already know. But accrual-based accounting is what we will do in order to correctly account for these transactions. So what do we do in accrual accounting? Now, accrual accounting operates on one basic principle, that we record transactions when they occur, not when the cash is received or paid. So if you buy something on credit, okay, we will record the transaction at the time you made the purchase, right? At the time you actually took the good that you bought, not when you paid for it. Okay, you might pay for it later, you might be paying for it over time, who knows? But the point is that we record transactions when they occur and not when the cash is received or paid. So it kind of requires a slightly new way of thinking about things. Typically when we think about accounts, or we think about our own accounts, for example, we normally think in terms of cash, right? If we have to, when we're doing our own budgeting for ourselves, we normally think in terms of how much cash is coming in and how much cash is going out. But accrual accounting is a little bit more accurate. It actually records expenses, at the time they occur rather than just when the cash is received or paid. Because sometimes, especially with big expenses, the cash might be paid all up front, but you might actually use the item over a period of time, right? So you may actually think that recording the expense over time is better rather than all up front because you're using the item over time. So we'll talk about a variety of different examples later on when accrual-based accounting provides significant differences with cash-based accounting. So this the example that we've already seen. So let's say a customer buys a good on credit. What does the company then do? Well, the company will record the sale even though the cash has not yet been received. Okay? So from a company's perspective, the reason they do this is because it allows us to track actually when you're making sales, right? If you want to know when you're selling the most or what periods of the year you had high sales, it's better to do it at the time the sale was made rather than when the cash had actually been received, because that will not be exactly the same and that may not be as accurate. The other thing the company will do is record the expenses related to the sales even if the cash has not gone out yet. So in this scenario, let's say for example the company sells me an item, okay? I don't pay for it as yet, but they record the sale anyway. Now what they should also do is record the expense at the same time, right? Because they've in producing that item they've had to incur an expense. They need to show some cost against what they've sold to me, right? If they don't show any expense, then all that revenue will just look like profit, even though it's not. So the company has to record the expense at the same time that they make the sale, even if they hadn't paid for the expense as yet. So what this does is that it allows the revenue and the expense of a particular item, of a particular transaction to be put together, and allows us to really nicely see, what are the company's actual revenues and expenses. Because the timing of cash flows may be very different, and this could cause a lot of problems when we're trying to do our analysis. So accrual accounting has the main advantage that it allows for a more accurate representation of a company's transactions. Cash versus accrual accounting method. So now that we understand well what is the difference between cash accounting and accrual accounting, let's talk about what are the main advantages of accrual accounting. So one of the main reasons we like to use accrual accounting, and we alluded to this a little bit earlier, is that cash-based accounting suffers from a disadvantage is that it is not good at tracking historical growth. So if a firm is growing over time, if I were to look at its profits over time versus its cash flows over time, if I actually look at the profits and losses which are based on accrual accounting, this does a much better job of tracking the firm's historical growth. Okay? Cash flows tend to be much more volatile because the timings of expenses and revenues are not matched together. Furthermore, cash can include transactions such as dividends, or does not include things like depreciation, and that's a problem. That means that we don't actually get an accurate picture of the company's actual financial performance. So when it comes to tracking growth, accrual accounting definitely has the edge. So when we use cash-based accounting, because the timing of cash flows varies so much, it becomes difficult to compare the quarter-on-quarter or year-on-year sales with that approach, right? Because the timing of cash flows is mismatched, it may be the case that in one quarter I had a lot of cash inflow, but I didn't pay for everything until the following quarter when there was big cash outflows. It may actually be the case that my actual sales in terms of timing was the same across the 2 quarters, but my cash flows could be very, very different, right? So when it comes to comparing companies' performance over time, looking at how they performed this quarter versus last quarter, or this year versus last year, in these situations, accrual accounting does a much better job of telling us this information. So as we said, accrual-based accounting records transactions as they happen, and hence is a better system of providing like-to-like comparison. A statement that is prepared based on accrual accounting and the one that shows whether a firm is making a profit or not is the income statement or the profit and loss statement. So the income statement that we saw in the last lecture, or the profit and loss statement that we saw in the last lecture and discussed previously, this is based on accrual accounting. So nearly all firms use accrual accounting. In general, only very, very small firms or single businessmen, for example, might use cash accounting, but generally, if the firm is of a certain size, and usually that size is not very high and not very big, they'll be using accrual accounting. So we need to understand what it means, and this is what the profit and loss statement is based on. Now, one of the only caveats about accrual accounting is that sometimes misrepresentation can occur. Sometimes, for example, the cash flows, you may record a sale even if the cash flows are not received, but if the cash flows may be uncertain, for example, because they may not get paid on time or paid at all, then you have to make provisions. So there is some room for manipulation when it comes to accrual accounting. We'll talk about misrepresentation later on in this lecture, but we did talk about this earlier, that when we're looking at cash flow versus profit and loss statement, the cash flow statement is more difficult to manipulate, right? It is more difficult to manipulate the cash flow. It is a little bit easier to manipulate the profit and loss statement. So accrual accounting is much better in the sense that it does provide us a much better way to understand what the company is doing. But we only have to keep the caveat in mind that it is slightly more prone to misrepresentation as compared with cash-based accounting. And over this course, we'll learn how to spot when accounts look a bit funny or when something is wrong. Notes to financial statements. So now we're going to turn ourselves a little bit and go back to understanding a company's accounts. So we've talked about accrual-based accounting conceptually. So hopefully this will clarify even better to us, the differences between the profit and loss statement and the cash flow statement. Now I want to talk about another part of the accounts called the notes to financial statements. And as we said, this part is sometimes a little bit messy. Now most companies usually have additional statements to supplement the first 3. So the notes to financial statements usually contain information that the company feels is relevant for investors to know, okay, that they are reporting, but that doesn't nicely fit into either of the first 3 statements. And when we actually look at one, you'll see many different examples of them. So usually it often consists of more detail on how certain items were calculated. So you might have, say, certain line items on the profit and loss statement, okay? You might have a particular line item which, let's say if it's quite large and it may not be obviously clear how that's calculated, then the company can include a note to the financial statement with a little bit more detail on how that number was calculated. So that's one of the key parts of the notes to financial statements, and this is called providing some clarification, right? Providing clarification on the numbers that you see in the first 3 statements. So because of this, the notes to financial statements are very important for valuation analysis. Sometimes when we look at how certain items were calculated or where certain items came from, this can give us a clue as to whether that's something that would be sustainable over time or something that's just a one-off and not sustainable over time. So that's why, when we're doing valuation analysis, we pay close attention to the notes to financial statements. Even though it's the case that the first 3 statements, say the balance sheet, profit and loss, and cash flow statement, provide us usually with the most information most of the information we need to know is in those 3. There are critical bits of information that are in the notes to financial statements, and they can only be understood alongside the other statements, but they are extremely important for valuation analysis. Sometimes another statement that is included in the notes to financial statements is called statement of changes in equity. So we talked about shareholders' equity earlier. This forms part of the balance sheet and is equal to assets minus liabilities. And companies often include a statement of changes in shareholders' equity. So changes in equity would be referring to how the equity has changed over the past year. So equity, as we said, consists of investor capital plus retained earnings. So looking at the changes in equity would look at if there was additional capital or share buybacks or dividends paid or earnings retained, etc. And finally, the notes to financial statements also include various provisions that the company has made. So the company may set aside cash for certain things that are coming up. So one such example might be, let's say the company is facing a potential lawsuit in the next year. They may have set a provision or kept aside a certain amount of money in order to cover the costs of that. Okay, and these sometimes, if there are big items in here, then we'd want to be aware of them if they could materially impact the company's ability to operate. So provisions can be for a variety of things, even something like if they expect that a customer, for example, isn't going to pay, or that they're going to not have a cash inflow even though they recorded the sale, then that's something you might see in the notes to financial statements. Okay, so now what we will do is we will go into the PDF and look at Maruthi's financial statements once again, and we will look at some of the notes to financial statements. Notes to financial statements, Maruti Suzuki. So now what we want to do is we want to look at and analyze the notes to financial statements. So in the previous lecture, we saw Maruthi's accounts, and we looked at the balance sheet, the profit and loss statement, and the cash flow statement. And now in this lecture, we want to go through the final part of the accounts, which is the notes to financial statements. And if you remember, when we saw each of the accounts in the last lecture, a lot of the items had a reference to the notes to the financial statements. In fact, a large number of items did. And usually what that means is that you can find more information about each of those line items in the notes to financial statements. So first, let me make a quick qualifier. The notes to financial statements is very long, so we will not be able to go through every single thing, and I will kind of just go through it a bit broadly. But in general, you can definitely read it on your own. I encourage you to do so. If you read it on your own, it will take you a little while. You might spend half an hour to an hour doing so, whereas we're only going to spend about 10-15 minutes going through this. So keep in mind we'll be going through this a little bit quickly because it's very long, but we should still get a gist of what's going on and an understanding of what exactly comprises the notes to financial statements. Okay, so the first note to financial statement, point 1, summary of significant accounting policies. So here what they have done is that they have essentially outlined the different accounting policies that the company follows. So here we have general information, and this tells us, well, what does the company actually do? Okay, we have basic preparation for financial statements, and here they've written under what regulations that these financial statements have been completed. The next point is revenue recognition. Okay, and this talks about how they recognize revenue. Then we have fixed assets, so what comprises fixed assets. We have borrowing costs, which tells us what does the borrowing costs comprise of. Depreciation, amortization, and this tells us how depreciation has been applied. So you can see here they've written fixed assets except leasehold land are depreciated in the straight line method or pro rata basis. Okay, so straight line method means that you depreciate an equal amount in each year. And here it tells you the length of time that they use for depreciation of each assets. And then they have depreciation of other assets here as well. The next point they mention is inventories, and this tells us how they actually recognize inventories and what they account for them. Investments, and we have investments are valued at the lower of cost and fair value. Okay. And tells you how they value the investments. If you value something at cost, it means you value it at what you paid for it. At fair value, it refers to the market value or what you would get if you were to sell the investment. And then we have research and development, and how they recognize that. Then we have foreign currency translations and derivative instruments, so how they account for those. Okay, and there's a lot of detail here as to what they do with those, and we won't go through those much. So we have then employee benefit costs, and this is referring to how they recognize employee benefit costs, and they're talking about a defined contribution plan, which is a pension plan. Okay, then we have customs duty, government grants, and taxes. Now taxes, again, it explains here what deferred tax is. So deferred tax is recognized for all timing differences, and they kind of explain how their tax treatment works. Dividend income and interest income, again, fairly straightforward. We have impairment of assets. So impairment of assets is when an asset has to be written off because it's lost value. We have royalty, which the company has to pay royalties, and they also talk about intangible assets and what that is over here. Then we have provisions and contingencies. So provisions we mentioned are there is a possible default or a possible lack of payment on something that they expect, or they expect to pay out something for some particular reason. So provision just refers to something that they keep aside. And then we have cash and cash equivalents, and explains what those are. Okay, so that was point 1 of the notes to financial statements. Okay, and that was very descriptive, so it went through different items. Point 2 now refers to some detail for particular items that were calculated. So first we have share capital. The total share capital of the company is rupees 1,445 million, and this is 288.9 million shares of rupees 5 each. And then we have equity shares held by the holding company and its nominees, and how the shareholders are broken up. Reconciliation of the number of shares outstanding, again fairly straightforward. Rights, preferences, and restrictions attached to shares. So we have par value of 5 rupees per share, and then how they vote, etc. And again, shares held by each shareholder holding more than 5% of shares in the aggregate shares of the company. So again, who holds shares of Maruti Suzuki? You can see the percentage breakup over here and the number of shares. Point 3 is reserves and surplus. So this was the second part of equity, right? Shareholders' equity, and then this refers to all the how we actually come up with this number. So general reserve, there's a hedge reserve, surplus in the statement of profit and loss, and then again you can go through each of these items to see exactly what comprises the reserves and surplus. Point 4 is long-term borrowings, and we can look at what their long-term borrowings were. They didn't have any as of 2012, but they did have some as of 2011, and this gives you the interest rates that they paid on those borrowings. Then we have deferred tax liabilities, the net deferred tax liabilities, and this tells you how where the actual deferred tax liabilities come from, what things they come from. So we have, for example, fixed assets, capital accounts, allowances, etc. Then we have other long-term liabilities, and it tells you what this comprises of: deposits from dealers, contractors, and others. Point 7, we have long-term provisions. So these are provisions that the company has put aside, and we can see here that we have retirement allowance, then we have litigation disputes, warranties, and product recall. And then we have some other provisions as well. So litigations, disputes, warranty, product recall, others. So this kind of breaks down these other categories, classifying them long-term, short-term, and what's happened during the year for all of these. Point 8 is short-term borrowings. This breaks up where their short-term borrowings are coming from. So banks, cash credit, buyer's credit, and packing credit loans. Then we have trade payables, so who they have to pay on to. So we have a small amount to micro and small enterprises, and the rest are to others. And point 10, we have other current liabilities, and this comprises of quite a few different things. So it only goes up to here. So we have current maturities of long-term debts, accrued interest, unclaimed dividends, creditors for capital goods, payables, book overdraft, advances from customer dealers, statutory dues, deposits from dealers, contractors, and others. So remember we mentioned earlier, the last lecture, that there was a line on the balance sheet called other current liabilities, and then you can go in here and see exactly what that comprises. The next item we have is short-term provisions. So this was another item on the balance sheet, and we can see what exactly those provisions are for. So we have retirement allowances, compensated absences, and then other provisions, warranty and recall, litigation, etc., and taxation. Then we have a detail of the dividends, so final dividend proposed for the year, amount of dividend proposed, and dividend per equity share. And here, which unfortunately is a little bit difficult to see because it's sideways, we have point 12, which is tangible assets, and we have point 13 here, which is intangible assets. So all of these lines are actually pretty straightforward. I apologize for the fact that it's the wrong way. What you can do is that you can download this PDF from Maruti, and you can be able to turn it yourself on the computer. And again, but all of these items are pretty straightforward. It just tells you what their total assets, tangible assets and intangible assets, is comprised of. Then we have point 14, which is capital work in progress. So this tells us where the capital is currently being used. Then we have point 15, non-current investments. So investments in subsidiaries, joint ventures, etc. And we have also other investments, so investment in corporate bonds, mutual funds, preference shares. Then we have more items about investment valuation. Point 16, we have long-term loans and advances. And again, you can see all the various things that comprise long-term loans and advances. Point 17 is non-current assets, so what non-current assets comprise of, and this is fairly small. Point 18, current investments, so investment in mutual funds is quite significant. Then we have point 19, inventories, and this kind of breaks up their inventories and also tells us where those inventories are, so at the factory or in transit. And we have trade receivables, so this is money that they are owed, and you can see it's broken up into considered good and considered doubtful. And then we have cash and bank balances, where you can see what makes up their cash balance. Point 22, we have short-term loans and advances. Point 23, we have other current assets. And again, both of these are divided into considered good and then considered doubtful. We have gross sale of products. So this kind of breaks up what they sold to their vehicles, and the second one was spare parts, dies and molds, and components. There's some breakup of other operating revenue. Remember on the income statement we had other operating revenue. So this breaks that up. And then we have the breakdown of other income, right, which we said was quite significant, and we can see where all of this comes from here. Point 27 will be increase and decrease in progress, finished goods, and spare parts. And this is about their work in progress and their stock. Point 28 is employee benefit expenses. So you can see the majority is salaries, wages, and then there are a few other things like provident and other funds, staff welfare expenses, including pension plans. And here we have more detail on the various defined benefit and other plans that the company has for its employees. And there's a lot of detail here. And sometimes when this is very large, it's worth analyzing and seeing if this is going to be a problem for the company in the future. So they definitely put a lot of information on this. So let's just keep carrying on through here. Now, point 29 is finance costs, and we see the breakup of the finance costs. Point 30, depreciation and amortization, we see the breakup of those two. And then we have the breakdown of other expenses as well, which is all over here. Then we have contingent liabilities, which is claims against a company disputed and not acknowledged as debts. So again, there are various things here that you can read yourself, and there's quite a few different things here. So we want to see if this was significant. Would this significantly impact their financial performance? And then we have expenses incurred on research and development, auditors' remuneration, CIF value of imports, expenditure in foreign currency, earnings in foreign currency, dividend remitted in foreign currency, value of imported and indigenous materials, license capacity, installed capacity, and actual production. And there are actually a lot of other items, and a lot of the remaining items are small items that are not necessarily as important. And you can kind of go through each one and see. We won't really go through all of them now because it'll just take too long, and it's not worthwhile to do so. But hopefully now you get a good idea of what is in the notes to financial statements. There's quite a lot more, so I would highly encourage you to actually look at it yourself. Unfortunately, we don't have the time to go through the entire notes to financial statements in detail, but you can see that you really get a good breakdown of what is in the company's accounts. So when you look at the initial balance sheet, profit and loss statement, and cash flow statement, to actually see the breakdown of all of those categories, you can go to the notes to financial statements. Okay, so now let us head back into the PowerPoint. Conclusion. So now we have reached the end of Accounting Basics. This is the end of the second lecture of Accounting Basics. So what have we done? Well, we continued our discussion on Accounting Basics. And these are the topics we covered this time. So we covered the cash versus accrual accounting method. And cash versus accrual was about how the timing of cash flows was not necessarily going to coincide with the timing of when the transaction actually takes place. And accrual accounting records transactions actually when they take place rather than when the cash is paid or received. Then we talked about the notes to financial statements, and we looked at the variety of different notes to financial statements, for example, within Maruthi's accounts, that you see that provide us with a good supplement to the overall accounts. By now, we should be in a position to read and understand a company's financial statements. So if we kind of think about our progress and where we need to be by the end of this module, by the end of this lecture, is that we need to now be in a position to read and understand a company's accounts. So the next lecture that we're going to go on to, and lectures beyond this, are going to now assume that you know how to read a company's accounts. Okay? So if you're new to accounting, then I suggest you take a little bit of time, maybe go through this lecture another time, and go through other companies' accounts. Make sure you really understand the concepts. Make sure you can look at a company's accounts and understand what's going on. So I mentioned this in the previous lecture, that it is a good idea to go through the financial statements of few different companies to get more comfortable with them. Now obviously we've gone through Maruthi's financial statements, and I've kind of gone through that with you line by line, explaining each item. Now the next thing you need to do is actually go and do this for yourself. In order to test whether you really understand accounts, you need to go through a set of accounts that you haven't seen in the lecture, right? If you just go through Maruthi's accounts, then it'll all be familiar. So it's best to go through another set of accounts, a different company, and go through it, and you'll find that there's differences between how they report it and how Maruthi reports it, and see if you can make sense of that and see if you can understand what's going on. Okay, so I would highly recommend you do this, and make sure that you're comfortable with accounting, and make sure that you're comfortable with reading accounts before we move on to the next set of lectures. So speaking of the next set of lectures, the next lecture is on financial ratio analysis, and then what we're really moving on to at this point is actually analyzing the accounts. So what we've done so far in the last two lectures is just understand how to read the accounts, right? How to read the accounts, how to understand the accounts. Now that we know how to do that, the next step is to actually analyze the accounts. Right? What are the key figures that we're interested in? Right? What should we look at when we look at a company's accounts? So we'll start that discussion in our lecture on financial ratio analysis, and then we'll take it from there. Okay? So thank you very much for listening, and see you next time.